Hey everybody, fantastic show today. Key Lee from Elevate Real Estate Investments comes on, talks to our group how he scaled a portfolio from just a few units all the way up to 60 units in Columbus, Ohio. Key is a real estate syndicator and investor from the West Coast as an airline pilot and professional poker player. Key brings some really unique views to this industry. So thanks, Key, for joining.
The knowledge is actually a small piece of the pie. The biggest piece is, I'll say, the mindset. For me, before I met the guy on Bigger Pockets, my reality was that I could only buy a fourplex. But after I talked to him, my reality changed. And the only thing that changed was my mindset.
Welcome to the REI Partners Meetup. We're your hosts, Matt Morrow and Richard Clark. This is a place where knowledge is shared, friends collaborate, as we help each other to succeed in both our real estate and personal goals. We are a group of like-minded individuals from across the country who are here to help and support each other. Investors, realtors, entrepreneurs, and many others contribute to providing diverse and practical content for our events, especially our mentors who enjoy helping new and experienced investors in their journeys. Thanks for joining. We hope you enjoy the show and encourage you to bring others who may find value as we invest in our collective future. So let's start with, I'm going to put him on the spot because he just joined in. I'm going to go with Justin.
Hey guys. Hey, I'm Justin Tyler. I'm a real estate agent and a landscape architect. I don't have any investment properties currently. I am currently trying to buy my own house as we speak, and I'm just looking to learn a lot. I've learned a lot from Matt already, so I always like sitting on these calls because they're very informative and hopefully help me get to where you guys are one day.
Awesome. Wargo.
Hey, I'm John Wargo. I live northern Colorado. I'm a licensed real estate agent here. I just got my, I will have my license next week in Pennsylvania. Application is in, everything's going through okay. I'm a former investor. When I was in Pennsylvania, when we moved out here for a couple of years, we sold everything back home and moved out here. So looking to come back over the next 12 months and re-engage.
Awesome. Thanks, John. Ryan.
Yeah, my name's Ryan. I'm a real estate investor from Allentown, Pennsylvania. I'm also a manager at a plastic manufacturing company up in Nazareth. It's good to see everybody here. And I look forward to hearing your story, and seeing how you amassed such a huge amount of properties. Don't
let Ryan be modest. He's killing it. He's doing a really good job, and he's probably feels really good to be able to say that he's an investor now. And we're super proud of him. Time,
so yep.
He is finally in the game. Leaky toilets and all yesterday, right?
Yeah.
All right.
Get that taken care of on Wednesday. So.
Hi everyone. I currently do not have any properties because my dad and I, Bob Sacco, also on the call, just recently pushed the paperwork to start our own LLC. So as of now, we're just kind of putting our feelers out to look at properties that come up. So not under contract. We don't have any so far. We're just kind of trying to see what comes up.
Awesome. All right, Bob, you.
My turn?
Yeah.
Okay. Bob, I'm Doug's dad, and I was a real estate investor for 20 plus years. Sold off most of the properties, still have one in Bethlehem, a 2-unit that I live in one, rent out the other. And looking to work with Doug and see if we can find some more properties. And my girlfriend Christine is around here somewhere. We're in the process of converting her house in Allentown into a rental.
Cool.
So, dabbling back into it.
Nice. I see Johnny.
Hi. He invited me here, so we both went to Nick Forducci Real Estate Academy. So I started doing the real estate investing since pandemic hit, so we've been flipping now, and so I have like 6 property in the surrounding area, Pittsburgh, Pennsylvania, for rental. Yeah, I'm from San Francisco, California. I live in San Francisco, California. So the goal is trying to be like Keys, the ultimate goal is to have apartment building is a few $1,000s here and there. Is just too much to, it's not big enough to me. So that's why I'm here.
Awesome. Thanks, Johnny. Remy, if you could hear us here, you want to do a quick intro? I know you kind of did before, but just people who didn't hear it.
My name is Remy Contreras. I'm French Portuguese. I've been in America for a good decade or more. I was in LA before playing poker. I met Key. We became good friends. He was my mentor and coach. Then he convinced me that real estate was good for this this next phase in my life, and yeah, I agreed. I have an apartment in Europe, which I do Airbnb, as I said, and I mean short rental. And my end goal is 100% multifamily. I'm now cold calling and creating relationships, and I'm based in Miami, Florida. And I hope to be connected with Key until the rest of the days, because he's the most serious person I know. Yeah.
Awesome.
My story.
Thanks, Remy. Brian. You're muted still. There you go.
Yes, my name is Brian Walter. A land wholesaler, and sometimes houses, but mostly land lately. And then my day job is a biomedical engineer. So I kind of do that on nights, the wholesaling on nights and weekends. Thanks.
Thanks, man. Jennifer, I think you're next in line.
Hey guys, I'm Jen. I was also invited by Key because of our poker connections. But I was working as a lawyer for a couple of years, and I decided to get into real estate. I kind of been learning, studying about it for the last year or so, and bought my first deal, which is a multifamily in Philly a few months ago. That's my first real BRRRR. But before that, I was doing Airbnb on the side for a couple of years while I was working. So yeah, I'm based in Philly, and very nice to meet everybody.
Thanks, Jen. I see George.
Hey everybody, sorry not on camera. My wife has the office today since it's been snowing, but my name is George Naif. I'm a real estate investor over in Fountain Hill, Pennsylvania. That's the Lehigh Valley area. And just have a house hack, renting out one side, living in the other right now. Goal is to get 20 units myself. And then I'm also an advisor that helps real estate investors work on both sides of the balance sheet to invest in real estate. So it's a little bit about what I do. Thanks for having me.
Thanks, George. Jim, if you can hear me, if you want to give a quick intro, if not, I'll just read the one you sent. All right. Jim's the one there on the phone. He's taking care of some snow business. He's a pilot, just like several of us on the call here, department manager for a small flight department, lives in Snexville area, and he's just starting the game. So we have a lot of interest from him and some of the other pilots on the phone. We're on the call here, but that's Jim down there. Ken, can you hear us?
Yeah, can you hear me?
Yep, I got you. Go ahead.
Okay, yeah, I'm on an old laptop, so I don't have a camera. My name is Ken Morrow. I am Matt's dad, and I am retired about a month now. So sick of working for a living. Look, did my time. So now I'm just looking for something to play with. And Matt got me interested in this. So I don't have any properties, but I'm willing to learn and listen and jump into things here.
Awesome, thanks.
So that's it for me.
I think Moses, you just called in. How about you give a quick intro if you don't mind?
Hey guys, I'm Moses. I'm friends with Matt, and I don't have any properties yet, but I do have an interest in maybe I'm trying to do something, some type of investment in properties, whether it be a flip or rentals that I'd keep for long term. So, appreciate you guys just letting me hang out and start to, continue to work on my education, concerning these ideas. So.
Thanks, Moses. All right, everybody, we're going to get into our beginning segment here. Richard is unable to join the call today, unfortunately. I'm going to sub in for him to talk about the quick terminology thing that we have every call. We started doing this 2 meetings ago because there's investors on this call who are brand new, just getting started, to guys like Key and other on the phone or other on the videos that are going to watch here shortly. That have 60 plus units, and it's a really, really cool thing to have everybody in the same room. But sometimes some of the words that we say and the terms that come up might be over the top of several of the heads here. So we try and just touch on at least one term, talk about it kind of in depth for a few minutes, and then we move on, and we'll have Key kind of carry us out for the rest of the thing here. So today's term Richard was going to talk about is the words cash flow. It's kind of one of the most important terms in real estate investing or in investing in general. Cash flow, I'm going to share my screen if you can let me know if you see this or not. Can everybody see this?
Yep.
Yes.
All right.
Yep.
Cash flow is a real simple thing. In real estate investing, you can invest for cash flow, invest for appreciation, or a few other terminology or a few other pieces. However, when you're investing in a piece of real estate, everybody on here who's owned real estate knows that it's only an asset if it makes you money. So your primary house, one could argue, and Robert Kiyosaki would argue, that it's not necessarily an asset because it costs you money every month, regardless of what you do. Cash flow is essentially the difference between the money you pull in, take out your expenses, whatever that net profit is at the end, is your cash flow. Now, your cash flow on one property, for example, this property, might be different if you own it or if someone else owns it, because your cash flow is relative to your expenses, your operating parameters, and your loan payments. Now, if you have a loan on a piece of real estate that you buy, whether it's a single family or a multi-unit or a commercial building, if you have a loan, that's going to come out of your net operating income, and then your cash flow is going to go down, which is why typically when your real estate is paid off, if you hold it that long, your cash flow has a huge jump after the 20 or 30 year mark when you pay off that loan. However, if you buy something cash, this cash flow number is going to be a lot higher. There's 2 schools of thoughts with this. If you buy something cash, now all of a sudden that money's tied up in an asset. It's not doing anything for you. Or you could use someone else's money to buy the asset, take a less cash flow every month, and use that other money that you would have saved to do other things. That's the quickest way to scale. I'm sure Key's gonna take that one home later today. Using leverage and using financing is a really important thing if the terms are right. You don't want to burn yourself though by getting into a situation where your cash flow is not positive. However, we all saw a few meetings ago when TJ presented his first deal that he got. Your parameters are really based on your wants as an investor. What are your goals? So sometimes having a cash flow of $0 to $100 a month for a single family, it might not be a bad deal if it's your first one and you kind of inherited this thing and it's covering its bases. There's all these different fields that are important to some of us and maybe not to others. But in the end, cash flow is the net of the net, whatever you come away with at the end after all of your expenses. And I'll show you how this is broken down here. You have a gross rent. This particular building is 5 units. Here's the gross rent for all of the different units. Vacancy is an expense that you'll have calculated on every unit forever. until people have always found a home, which we know it's very easy to fill units right now because there's a lot of people looking for homes. However, vacancy, you should plan on at least 5 to 10% on a residential. The bank, depending on their comfort level with you and the comfort level of the market they're lending in, that vacancy number might be a little bit higher. Your operating expenses also come out of your cash flow, your net operating income. So you have operating expenses here for this building, happen to be all these items here. So of $5,300 a month, after your vacancy, you have $5,000 as operating income. After all of your expenses, these are owner paid expenses, things like electricity, natural gas, if the tenant pays oil, things like that would not count on your expenses. However, just be mindful if one of those units does become vacant, now all of a sudden that should kind of be on your expense report because you're responsible as a property owner to cover that bill until someone else moves in. So your net income, $3,100 a month. After you pay your mortgage, which is a really stellar deal, your cash flow here is $2,100 per month, which if you ask me, for a 5-unit in the Lehigh Valley, this is the definition of a slam dunk because this is a very, very good cash flowing unit for this part of the country with these kind of returns. If you go up over here, you see this fancy little graph, and then you can go to the yearly, and you can see how quickly these numbers add up. So gross rent, 63.6 over a year for a total of 64.20 after some vacancies. Net operating income of 37, and after your loans, this is 25,435 cash flow or net profit. This is after you save $6,000 a year for maintenance, $2,400 for capital expenditures. You put over $8,000 away for maintenance, and this is still $25,000 profit. That's cash flow. That number of cash you get to keep after all of your expenses is what's super critical. And having parameters that are important to you, your criteria, this is the biggest thing when you're looking to start investing. What do you need for a return? Do you have a certain time frame you want to hold this property? If it's a flip or if it's a long-term hold, there's different ways you approach it. Does it pass all of your parameters? Because if it doesn't, you might want to consider if you actually buy it. Because if you always compromise on something, eventually you're going to get somewhere where that compromise kind of hurts you more than it helped you. So here, this property obviously passes all these criteria. The 1% rule is a pretty the basic rule, meaning the rent has to be at least 1% of the property value per month. $100,000 house, $1,000 a month rent. $200,000 house, $2,000 a month rent. If it generally pencils out like that, it's usually going to be a good investment. But again, there's a lot of subjectivity to that. For this particular area, we wanted a cash flow greater than $400 for the units. And debt coverage ratio is also an important factor if you're going to be borrowing the money. The bank wants to see that this property can sufficiently cover its mortgage where you're not going to have to step in. So that's just a quick overview of the term cash flow. It doesn't matter what kind of building you're renting. Cash flow is not profit from a flip. Cash flow is monthly income that comes after your expenses from an investment. Flips are a little bit different because they're really counted as ordinary income. This cash flow term is one of the things that you should get really familiar with when you're looking to buy an investment property, because you don't want to buy something that's not going to cash flow positive. Cash flow can also be a negative. If you buy a property that really, really requires some work for the first year, you might have a negative cash flow, but after things are done, the second year you could have positive. That's where, Key's going to talk about the things that he did, value add opportunities. You take an underperforming building, you do some things to it, turn over some tenants, and now all of a sudden you take this thing that was not worth a lot and you turn it into something that is performing extremely well. So that's cash flow. Does anybody have any questions on cash flow or what it means or applications of it? Anybody have a experience on the call with negative cash flow? Where you started losing it? I hope so. What's your example there, Key?
Well, the first property that I bought, it was a disaster. I really wasn't prepared for what to expect. didn't do much due diligence, and I just dove in head first. And when I bought this property, it was like just tiny, like ugly little house in Utah, and I had no idea like what to do as an investor. I just had a chance to buy a house. This was in 2007 when they were handing out loans without much of a requirement. So the thought of being a landlord or house owner with no money down was just really compelling. So I bought this house. I didn't even know like this town, didn't even negotiate a good price. And I bought at the top of the market in 2007, and the tenants stopped paying rent after I bought. So I was, it's an understatement to say that I was in negative cash flow for a while. Luckily, it was a small property, and I was able to withstand the negative cash flow until I evicted a tenant, got a new one that actually paid, and was able to refinance the loan. But I had a rough introduction to real estate.
That's good though. You'll probably not make that mistake again.
Right.
When you talk about underwriting the deals moving forward, you remember those things that burned you, and you try not to make that mistake again. George, I see your hand up.
Yeah, I just have an experience of negative cash flow. This place that I have is giving me a negative cash flow in the beginning because we did a 5% conventional down payment. This was back in 2019 where the rates were about 4%. It was still, for me, it was still better to take the negative cash flow than keep paying rent, right? We were coming out about maybe $300 a month after CapEx and all that kind of stuff. Ever since last year, we were able to actually refinance, get down to like 2.85%, do a conventional loan because the market's just been nuts. So the appreciation just kind of kicked in and got the PMI off. And so now, I got that $300 back, and now I can truly say that I'm living for free. So when you're house hacking, it's all right if it's negative cash flow. It's still better than you renting like $1,200 a month. So always keep that in mind when you're investing as well.
George, that's a really good point. I think Ryan, you probably you feel that right there. So I'll let Ryan explain his situation here in just a second, but cash flow negative when you're buying it is not always a bad thing. That's a really good point that George brought up. In your personal situation, if you're going from paying rent to another landlord who loves you paying his mortgage down, you buy your own property. In George's perspective, he's house hacking. Living for free, or even at let's just make up numbers, we'll call it a negative $500 a month cash flow. If you're paying $500 a month to live there, but you're coming from a place that costs you $800 a month to rent, it's actually a net $300 more than you're used to. So to house hack and live in a rental at a minor loss, but not pay someone else is still a huge win in comparison to something else. So Ryan, why don't you give like a quick 3-minute overview of your little situation there? You got to unmute yourself. Sorry, buddy. There you go.
All right, there it goes. So basically, I bought a duplex in town. The bottom unit is a 1-bedroom. Top unit is a 3-bedroom. So it's a pretty ideal situation for an owner occupant because I could charge a lot more rent for the unit upstairs than I can the downstairs and just live in the 1-bedroom apartment. So basically, I got my first tenant a couple days ago, and the amount I'm charging for rent pretty much pays for the entire PMI. It pays for my utilities for living there. It pays for the majority of the utilities and the maintenance costs that I'm going to expend while living here. So it's a pretty good deal. I think at the end of the month, I'll be putting maybe $300 of my own money away just to put a little extra aside for maintenance, because there's definitely some improvements I'd like to make. But another thing to that too is I get cheaper auto insurance because that gets combined in my homeowner's insurance. And all around, my living expenses are pretty low a month. The only thing I got to really worry about is my gas and my food, and that's pretty much it.
Ryan, what was your rent that you were paying that landlord before?
I was paying $885 a month, which is really cheap where I live for a 1-bedroom apartment. Plus, if you put all my other expenses, utilities and stuff like that, it's probably around like $1,100 a month I was paying total. So now I'm paying about $300 a month. So, you know, you do the math on that, it's a lot cheaper living this way. Plus I'll have a lot of extra money saved over each month to put away for another property in a year or so. So I take the money that I was saving before, I take the money I'm saving now on living expenses, and I can maybe use that for a conventional loan in the future from a year from now. So yeah, I'm definitely going to be ahead of the game in a year or so. A lot better position.
You already are. For you, that situation, even though it's a negative 300 a month cash flow, you're $500 more a month less that you're paying someone. So you actually made $500 a month by buying this place.
Right. And I also have equity in the property too. So it's another thing.
Yeah. You had a few you had a few surprises your first day in that property and with renting it.
Yeah,
So
I mean, there's going to be there's some rough patches, but the good thing about that is I'm gaining the experience and dealing with a lot of problems.
That's for sure. Anybody else have an experience here?
Contractors and I'm sorry, what'd you say?
Sorry, no, finish up.
Yeah, like I said, you know, it's good that there's some rough patches in the road. You know, it's going to give me the experience of dealing with contractors and getting things fixed, and you know who to deal with, who not to deal with. And just in the future, when I go buy my next property, I'll be a lot more wise to how I do the whole process now that I've seen it once. But I think it's more important that at this point, I just go ahead and do it and not wait for this perfect opportunity that might never come. I don't think the first deal is always going to be, even though I feel like this one was a lot better than I thought it was originally. I think it's going to be a pretty darn good deal for where I live. But most of the time, the first one isn't going to be a slam dunk home run kind of situation.
That's awesome, man. Thanks for sharing. I appreciate it. Anybody else have any last minute stories on cash flow or negative cash flow they've experienced before we jump in with Key? Bob.
Off topic question. The looking at your screen, what is that deal check that you were showing there? What is that?
Yeah, I'll share it again here with you. Hang on. Can everybody see it?
Yes.
Can you guys see this one here?
Yep, we're seeing it.
Deal check is a website that Richard kind of got me turned on to here. It is a online property analysis tool that's able to import property data from public records. One thing that's negative with it that I do not like, anybody who's licensed in this business knows the word Zillow is synonymous with improper information, and it's basically you have to take it at your arm's length. However, this website is fantastic. It has the ability to import property into several of these different fashions. You can pull it up. You can go through all the different details, see if it's a good investment, see if it's not a good investment. And you can go back to, let's just go a new rental. You go here, import property data. We'll do, I don't know. Somebody give me an address.
1160 Howardtown Road.
Oh, hey, that sounds familiar. 1160 Howardtown. You pulled up tax records, don't want to save it. And it talks about that. Again, this is only from public record and it's coming from Zillow, so we're not sure if this is accurate. You want to verify this. Everything here talks about property value. We don't know if that's accurate. Again, Zestimates is worth its weight in toilet paper. Don't go by that. Always verify this information. Google Street View, and then at the very bottom, save and customize. What you could do here is you can work backwards from a maximum allowable offer price as an investor to see if this place is going to cash flow and see if it meets your criteria. And the way you do that is you go here, use financing, or you're going to buy it cash. You type in all the parameters for your loan, type in all the parameters for your purchase costs. You always want to itemize these things because 3% on a purchase is never standard. And then you go down to rehab costs if it needs any rehab. Rental income, again, we don't know if this is accurate. This is purely coming from a Zillow estimate. It's almost always wrong. Operating expenses, again, it should not be 50%. You have to itemize these things here. You want to make sure you're doing your due diligence. Long-term appreciation, be conservative with yourself. And then at the end, you go up here and you click this fancy little analysis button, and they'll tell you right off the bat, is this a good investment? Usually it takes about 4 to 5 minutes to put a property in here. You could generalize total rents, all those different parameters you put in here. And then what you can do, you can go in here. Let's just say this information is all accurate. I go to reports, I create a report, and this is what I take to give to the appraiser who I'm meeting on Wednesday at a multi-unit we have to refinance and pull a whole bunch of cash out of one of our places. I give him this. Here it is. It's branded. It does not say the word deal check anywhere on here, has street views or your own pictures, and has this nice fancy display of a map and other comps in the property, has a whole bunch of data here that people in our part of this industry love. We're all numbers nuts, and you have to be. Statement of cash flows for the month and the year, expenses, and then here's the cool stuff. Buy and hold projections, year 1, 2, 3, 5, 10, 20, and 30. See how your cash flow jumps after your loan's paid off in 30 years. Tax benefits, equity accumulation, sales analysis, and then statement of cash flows over time with these nice fancy graphs. Comps that pulls up. Again, you have to deselect some of these comps because a lot of them are very, very poor. They should not be used from Zillow. So you can deselect the comps that this program uses. And then rental listings to see what it should rent for. Again, highly subjective. And then at the very end, your purchase criteria. And then you can put as many photos as you want in this. So again, this website is called Deal Check. It is a fantastic resource. It is not cheap. It is a few $100s a year. However, I can tell you that this website has made us a whole lot more money than $200 a year for a membership, especially when you have reports that are valuable like this. So I highly suggest this to anyone who wishes to use it. There is a factor in this business where the image of what you present to people is huge. And if you look like you know what you're talking about, I present a deal check report to every one of my investor clients as a real estate agent. Now, that does not mean that I'm providing them this as an agent. It means I'm providing them as a fellow investor. Hey, look, man, if I were buying your house, this is the report I generate. I'd like you to see this and keep it on your files. It's not official, but when you're going to an official place like a bank or a title company, you can show them this, and it gives you a lot of credibility. Deal Check is a fantastic website. It's not cheap, and if you're interested in it, send me a message afterwards. Richard has a code that he uses because he's the one that got me turned on to this, and it gives you a discount, and it gives him a little something for referring somebody to the website. But again, Bob, thanks for bringing that up. This is a life-saving website. If you're going to be into it, doing a lot of analysis, you could do the very same thing in a spreadsheet. And a lot of people do. However, for us, being able to remotely import properties when I'm sitting somewhere is worth its weight in gold. So Deal Check is a fantastic resource. And I think he found out from Bigger Pockets. So write the name down. If you're interested, send me an email afterwards and we'll connect to get you that code and give you a little discount on it. So thanks for seeing that, Bob. That's good. They love those reports. They look real familiar, really, really good, top-notch stuff. So, all right. Well, without further ado, 37 minutes later, Key, if you want to take it from here and just kind of roll with however the questions go, do a little intro on yourself, and we're all looking forward to learning more about you and your journey. I really thank you for coming on.
Hey, Matt, thanks for having me on board. I'm excited to be here. And my name is Key. I'm from Los Angeles, California. I've been an airline pilot for the past 17 years. I've also been a professional poker player and coach for the last 10 years. And I got into real estate investing initially through just single family home and triplex, rentals out of state and the house hacking. And it wasn't until 2019 that I got seriously into multifamily investing. And because the airline job is very flexible, I was always able to have a side hustle. And that's how I got into poker. And I've been doing that for the past 10 years. And I've transitioned out to multifamily apartments. How I really got started with the multifamily is I had a single family house and a threeplex. A threeplex was in Chicago. The single family home was in Utah. That was the negative cash flow property I was talking about earlier. And although the property was, performing okay, I wanted to take investing more seriously. So at that time, I wanted to sell my 4 units and buy another fourplex. I'll figure, I'd buy a fourplex, run it right, and make sure it performs well. So I did some research, got on Bigger Pockets, listened to some podcasts, read some books, connected with other people. And I connected with this one guy, and he's like, "Hey, Key, why are you trying to buy a fourplex?" I was like, "What do you mean?" He's like, "Why don't you just buy an apartment?" And at that time, I didn't know I was allowed to buy apartments. It wasn't an option for me. But this guy explained to me, you can absolutely buy apartments. And I have so many questions. I was like, well, what about qualifying for a loan? I don't have millions of dollars, and I don't make millions of dollars a year. And he's like, well, I didn't realize that commercial loans are more based on the asset's performance rather than the borrower's income. For a residential loan, the bank looks at the borrower and tries to determine if the borrower can pay for the loan. A commercial lender looks at the property and tries to determine whether the property can pay for the loan. And I didn't know that. So, I could qualify for a commercial loan based on the property's performance. And I also had no experience managing, 30 or 40 units. And this gentleman from Bigger Pockets explained to me that, how do you manage your 3 units? And I said, through a property manager. And he was like, well, how do you think you're going to manage 30 units? It's also through a property manager, where apartments is a way to scale. And it's a lot more scalable and profitable than, a single family house or even a small multifamily like 4 units. And I didn't know all the answers, but this idea planted a seed in my mind. I was like, apartments. So that's where I just went on to read as many books as I could, listen to all the podcasts, connected with everyone that I could, ask a bunch of questions. And I talked to one of my good friends from childhood, my friend Dan, and I told him what I was going to do. I said, hey, I'm going to sell my 4 units and I'm going to buy apartments in Columbus, Ohio. And he also had several, rental properties of his own. And he's like, you know what, I'm in. Let's do this together. So just like that, me and my friend Dan, we formed a partnership, and he sold 1 unit, I sold 4 units, and we took those 5 units and did what's called 1031 exchange. That's where you sell a property and buy something bigger. So we sold those 5 units and turned them into 60 units in Columbus, Ohio. And part of it was that properties are cheaper in Columbus, Ohio than, say Chicago or LA. I think we paid like 40 to 50,000 a door, where in Chicago and LA, the units cost 3 to 4 times more than that. But that was really our start in the multifamily journey, and we haven't looked back since. So that's the quick 3-minute story of how I got started in the journey.
All right, I'll start off with a question and everybody just fire away. If you want to either raise your hand or unmute so I can see it, we'll kind of tag team Key here, because I don't think he knows what's coming. There's a lot of people with questions. One of the questions that I know a lot of people in the group might want to ask you comes from a novice investor from the very beginning. If you could put yourself back in time to a position where you were just considering getting into real estate investing, whether you had your first one or not, that I guess it doesn't really matter for this question, but what gave you the mindset shift, and it might have been this conversation with the bigger pockets gentleman, to look past small multifamily or single family and to realize that you have to now start looking outside your backyard to invest? And what did that require you to do as far as analysis? Because there's a lot of things differently to analyze a property that's far away. I'm just curious your experience there.
Yeah, that's a good question, Matt. And part of it was, getting proper information and analyzing, doing thorough due diligence. But I think a bigger part of it was taking a leap of faith. I think a lot of people can be bogged down by analysis paralysis, right? We want answers for every what if question. Well, what if this happens? What if that happens? What if interest rate rises? What if, this happens? And the thing is, we don't have answers for everything. And there's a saying by Colin Powell that I really like, where he says, he never makes a decision with less than 40% of the information that's available. And he never makes a decision with more than 70% of the available information. And the idea is that if we try to get 100% of the available information, we'll never make a decision. We're being decisive. And big part of it for me was just believing this guy who was telling me that I could do it and just taking a leap of faith. I think George has a question.
Yeah, George, go for it, man.
Yeah. Thanks for your story. That's really inspiring to make that big of a jump. When you were actually, doing the 1031 exchange, do you know how much, just estimate kind of out of pocket you actually had to get for the down payment on the property? Because I'm sure the property that you own covered some of that, if not all of that. I just wanted to know kind of a little bit, maybe more details on that specific deal.
Yeah, George, actually, we didn't have to come out of pocket. Between the 5 units that we sold, that was enough for a 25% down payment for 2 properties. So one was 36 units in Columbus. The other one was 24 units in Columbus as well. And each property was $1.4 million. So the down payment for each property was about $350,000. And between the 5 units that we sold, that was enough to cover the down payment for both properties. So we didn't have to come out of pocket for any additional cost.
Oh, that's amazing. Thank you.
Mm-hmm.
Saw somebody flash their mic. Does anybody have a question or a conversation direction you wanted to start with?
Yeah, I have a question.
Go ahead, Ryan.
You mentioned that to get commercial loans, your properties had to be performing at a certain rate. Is there any can you go into a little more specifics about that, to exactly how well they have to perform to be approved for a loan like that?
Yeah, sure. And this depends on what kind of lender you get. There's different types of lenders, right? There's the local bank or credit union. There's also what's called bridge loan, which is similar to hard money loan you get when you flip a house. But there's also agency loan through Fannie Mae or Freddie Mac. And each type of lender has different criteria. In general, the lenders want to see that after year 1 or year 2, if the property needs to be stabilized, that the income from the property is more than enough to pay for the loan payment. And they call this the debt service coverage ratio. And basically, they want to see about 1.2, which means the income, the net operating income, which is what Matt showed earlier, the net operating income has to be 1.2 times the loan payment. To give an example, let's say your loan payment is $1,000 a month. They want to see that the net income after expenses is at least $1,200, which is 1.2 times the loan payment.
Okay. All right, that makes a lot of sense. Thanks for answering that question.
You're welcome.
Yep.
how did you get to the point of being able to work with a partner? I know you said you're a good friend, you've known him for a long time, but for some people that don't have access to a partner or the equity or investments of a partner to scale, what would be your suggestion for people to get to that point? Because it's obviously a kind of a difficult thing to do all on your own unless you have all of those assets.
Right. And I see real estate as a team sport. You can do it on your own, but you can go a lot further if you do it together. And there's so many parts to a deal, right? There's finding the deal, there's securing a loan, doing the due diligence, providing funding, hiring a property manager. There's just so many pieces to the puzzle. And if you try to do everything, is it possible? Yes. But as you start to scale up, how can you be, how can you be everything at once, right? So it really makes sense to partner up and to partner with somebody who has a different skill set than yourself. Obviously, trust and integrity is one of the most important pieces when considering a partnership, but you also want to make sure that your partner brings something different to the table. Like in my situation with Dan, Dan is what I would describe as a social butterfly, right? He has, he's like the life of the party. He knows a lot of people, and he has very strong relationships with a lot of high net worth individuals. And he comes from a banking background, so he has relationships with bankers. So I rely on him for raising funds and securing loans. And I focus more on securing the deal, calling the brokers, analyzing the deals, putting in the offers, doing the operations. So we, divide the roles that, fit our personality and our strength. And I feel that we have symbiotic relationship through the partnership.
What's your, oh, Moses, go ahead.
Hey, Keith, thanks for coming on and chatting with us. Appreciate you hearing your story. So I was just wondering if maybe you could talk a little bit more about why you chose Columbus. You mentioned a little bit, the pricing in LA or Chicago is might be more than what you want to spend or get involved with. But how did you find something in Columbus, and why did you go to that area versus anywhere else in the country?
Right. And it makes sense to invest in your backyard, right, where you can drive to the rental property. For me, in LA, it's a little bit more challenging to invest. The laws are not as friendly for the landlords, and also the pricing per unit is really challenging to get positive cash flow that Matt was talking about earlier. Oftentimes, the units are so expensive that in order for the property to cash flow, you have to buy it in cash rather than taking out a loan. After you make the loan payment, the income is not enough to cover all the expenses. So with that said, I looked at other markets, and whenever I analyze a new market, I look at several metrics. One of them being population growth. Are people moving into the area? And a more specific number is the net migration rate. And that's where if you have positive net migration, more people are moving to the area rather than moving out. Second metric is job growth. Everybody needs a job, right? So where there's job growth, there's going to be population growth. You want to look at places where companies are moving, or they're expanding their headquarters. It's kind of like in the Serengeti, right? In the Africa, all the animals, they look for a watering hole. Well, jobs are like the watering hole for people. So where the jobs are, that's where people will go. In addition, job diversity is important, because if one person or one company or one industry dominates the area, what happens when that company or industry takes a downturn, right? I think Michigan is a great example where most of the jobs came from auto industry, and when auto industry was struggling, the whole area just suffered. So you want to make sure there's good diversity in both industries and companies. We also look for good median income and supply and demand. Some areas there's some restrictions to supply, such as the coastal cities, right? There's physical limitations on where and how much you can build. So supply and demand is important, and also the legal landscape. Does it favor the landlords or the tenants? For example, in California, it's really difficult to evict the tenant even if they're not paying your rent. You can, but it may take years. And in the meanwhile, you have to keep paying for your own mortgage. There's a lot of legal challenges, that could make investing in California very different than investing in some other states. So to sum it up, I look for population growth, job diversity, median income, supply and demand, and the legal landscape of an area. And Columbus hit all those boxes. I didn't know anybody out there, but I liked the city due to the fact that it checked all the boxes. So my partner Dan and I, we flew out there. We met with brokers, lenders, property managers, and built a team.
All right. Yeah. Thanks a lot for sharing that. Appreciate it.
Yeah.
Go ahead, George.
Hi, I'm sorry to ask two questions. Hope I'm not taking too much time. But I know when you're doing the commercial ones, I know there's usually a 5, 10, 15, 20-year fixed period, and then a variable period, usually at the end of them. So is the goal for you to just keep on refinancing out of that and just keep leveraging, or is the end goal for you guys to kind of just eventually just get that paid down and just increase the cash flows? I'm just wondering, with someone who's just as far into it as you, like what the kind of end goal is, whether that's leverage forever or not, kind of thing.
Yeah, that's a good question. And it really depends on the project. Some projects are better for short term, others are better for longer term. And for longer term holds, I do like the ability to refinance, rather than paying down the debt. I think, as Matt alluded to earlier, if you pay down the loan, your cash flow jumps, but also a lot of equity is just being trapped. For example, let's say there's a $3 million apartment and you owe $2 million as a loan, and it still cash flows. Well, if you pay it down, your cash flow is going to increase, but that $3 million of equity is just being trapped in that one property. Whereas if you were to take out a loan and take the $2 million of equity, that can buy another property that's worth $6 million. So now, instead of just having one property that's worth $3 million that's producing good cash flow, you can have a $3 million property and a $6 million property, both generating cash flow and growing in equity. And that's really the power of leverage and the ability to scale. And that's what makes this business so lucrative. And so the short answer is yes, the idea is to take out equity and keep investing in other assets, keep leveraging our money and scale the business.
I guess a follow-up question is what kind of, I know a lot of investors have like a certain leverage point, whether it's like 50% leverage, 70%.
Mm-hmm.
Do you guys have a certain leverage point in your business?
Again, that also depends on the project, depending on the property, what location is it in, what kind of cash flow does it generate. And also right now we're at a time where the interest rate is a little bit unstable, where it could go up. Some people think it's going to stay the same, but nobody really knows what's going to happen. But in case the interest rate goes up, you want to have enough of a cushion where you're not underwater. So lately, as of the past 6 months, we've been gearing a little bit more towards lower leverage, whereas before we were just shooting for max leverage. We might try to get 80% leverage or 75%, but now we're looking at projects with more like 70% leverage, perhaps even 65%.
Awesome. Thank you for the information. It definitely makes sense. Thank you.
Mm-hmm.
Hey, Keith, would you
Yeah.
mind, because I know there's a few people on the call who are still learning about leverage and what it means, or even the term. Could you kind of go into a small detail when you say using 65 or 70% leverage in plain terms, what does that mean for you? And could you give an example?
Yeah, I'll give you an example. Let's say a property is $1 million. 50% leverage means you take out a loan for 50% of the value of the building. So 50% leverage on a $1 million building is $500,000 loan. So you have to put down $500,000 and the bank will put in $500,000. A 70% loan is the bank puts up the 70% of the purchase price and the investor puts in 30%. So in the same example, the investor will put in $300,000 and the bank will put in $700,000.
And are there any advantages to each in general or for your position? Obviously, you talked about high leverage and low leverage because of the interest rate, but are there any other advantages?
Right. I mean, in general, if the property cash flows, higher the leverage is generally higher the returns. With that said, with high leverage, there's also a risk if the property value declines, for example, or if there's some fluctuation in your monthly income, because the cash flow is lower at higher leverage. If you have some dip in the monthly income, you could hit negative cash flow. So these are types of things that you have to take into account as an investor. I know Warren Buffett once said there's 3 L's that brings demise. It's liquor, ladies, and leverage. And he was exaggerating to some point, but he just really was conservative and he was against leverage. But he also wasn't a big real estate investor, where in real estate investing, leverage is the name of the game, and that's what really enables investors to scale their business.
I'll ask one more question. I apologize for taking all the time here. Leverage is a wonderful tool, but at what point is too much leverage too much? Because you could do a lot in this business with leverage, especially if the asset is the lending point, meaning you are not having to put up all the cash if the property provides its own form of sourcing the loan. When should someone really consider the amount of leverage they are? Because you don't want to owe too many chips to too many people. You can get yourself in a corner. Any experience with that?
I think it comes back down to how much the property will cash flow and what kind of reserves that you have. Just to give an example, let's say you have 5 different properties and you have maximum leverage on all 5 properties. And let's say they all create just very little cash flow. Let's say $100 a month. Well, it's fine, but if there's a little bit of a downturn where your income is reduced, all of a sudden you're underwater and you're negative cash flow on 5 properties. And if the value of the properties decline, you're also underwater on the loan, where the bank may come back and call the loan due. So that's the type of, you're not leveraged so high with a little bit lower leverage where you have enough cash flow and you also have reserves that can rainy day fund in case things go south.
In the single family world, or even multifamily for most people on the call here, if you have properties in your name, usually there's going to be an upper limit to how much you could take on in the form of debt. Even if all of those properties are cash flowing, at some point the bank is going to be like, hey, Ryan, you have eight houses already. We're not going to be able to do much with you. So you could do a various form of things. You can go into portfolio style loan, or you could maybe sell some of these assets off or start putting properties into an LLC. Key, do you have any of your real estate in LLC or trusts, or is any of this in your personal name?
All of my investments are in LLC, especially for multifamily. It's very common for investors to put the property in an LLC, and LLC is a way to reduce your liability. It's not 100% bulletproof. There's definitely some things that investors should go beyond just having an LLC, but it's a start. And I don't want to tie up the business asset with personal assets, and I also don't want the different assets to commingle with each other when it comes to any sort of liability. So I have LLC for each property to segregate the risk.
Anybody have any questions for Key here? No, I saw some of these. I think it might have been Johnny's mic come off earlier. Anybody want to ask a question?
I have a question for Key. Hey, so for example, I don't know if this is like a sensitive question for you. So for example, the 36 unit in Columbus, Ohio, investing $350,000. What was the average positive cash flow you get per door?
Well, Johnny, that's it's a little bit challenging to answer because we only held the property for 12 months and then we sold it after 12 months. And on year one, we had what's called interest-only term. So the loan payment consisted only of interest and not principal. So what happens is when you have interest only, the loan payment is artificially low. So even though we had very high cash flow on the first year, it's not a very accurate view of what the true cash flow would have been for the property. So our cash flow for year one was $100,000, but year two would have been much lower because year two would have been the regular principal and interest for the loan. Yeah, our goal was to hold the property for 5 years, but after 1 year, we got an offer that we couldn't refuse. So we ended up selling the 2 properties, and then we ended up buying 2 properties in Reno, Nevada. And currently we're under contract for 3 properties in Ohio and 2 properties in Charlotte, North Carolina. So right now we have 5 properties under contract.
And how are you able to get all those money to put down payment? Not all of us have the kind of money to put down payment, $250,000 to put down. So how? Well,
so for the first Columbus properties, it was through 1031 exchange from our triplex and single family home. And then we sold those 2 properties in Columbus, Ohio, and bought 2 properties in Reno. Now for the 3 properties in Columbus that we have now under contract and 2 properties in Charlotte, North Carolina, we're raising funds from family and friends. They saw what we're doing and they want a piece of the action. They're like, hey kids, so what are you doing in real estate? How can I get involved? So we're partnering with family and friends who want to invest passively and who want great returns and also tax benefits, where we do all the work and we partner on deals.
The equity partner, like you mean, so they're investing. So how are they like equity partners, or you just give them?
So we're partnered with limited partners who are passive partners, and they essentially provide equity for the deal. And we do all the work. We have the broker relationships, the lender relationship, property manager, and we analyze the deal. We put up the EMD, all the risk money, and we form a partnership where each partner owns a piece of the real estate. So we own the property together, but the capital partners bring in the money, and we provide experience and hustle, and we do the deal together through that partnership.
Good. Good. Thank you.
You're welcome.
Yeah, that's a really good example there, do you have any equity? Again, this is a question you might not want to answer. Do you have any personal liquid or through your company as a partner in these, or are you, is that
Yes,
your
absolutely.
contribution? Okay.
Because anybody who's going to invest with me, they want to know that I'm also putting in my own money in the deal. If I'm not putting in my own money into the deal, why should they? So we make sure to put in some equity into all of our deals.
And you act as the general partner, and you have a whole bunch of
Yes.
limited partners for
Mhm.
each specific operation.
That's correct.
And Johnny asked a really good question. Not everybody has the money to be able to foot these big bills, but if you find people, even smaller investors, you get into this SEC issue where you're soliciting people for funds, or this all private people who reach out to you, say, we want to put our money somewhere, we trust you, Key. How do you source these?
For now, we do what's called 506B fund, which is limited to family and friends or people that I have relationship with, or that at least have contact with prior to the deal being under contract. So for example, right now, if somebody were to come up to me from this group and say like, hey, Key, I want to invest you on your current deal in Columbus, like, well, I can't accept that, but then maybe for a future deal, that's possible. I think Remy has a question. Yeah, he had his finger up for the past 5 minutes.
Oh my gosh, I'm sorry, dude. Go ahead, Remy.
Hey, Key, you have a very interesting story. I have a question about, so with the little experience I have, I see that looking for this type of properties on MLS and stuff like that, places like that is not the best way. Can you tell us your strategy to find the properties off market so that you find a little bit of meat in the bone, like you guys say, just to explain how you do it?
Yeah, so for multifamily, there's not good MLS. For single family house, you go to MLS, there's a ton of properties, right? For multifamily, there is no such platform. I mean, there's a couple that exist, but it's very inefficient and not good. What happens is a lot of the multifamily deals are done off market. The broker has personal relationships with the owners. The good brokers reach out to all the owners and say like, hey, I'm the top broker in town. If you ever want to sell, come to me. And what happens is the broker brings the buyer and the seller together in a private transaction. So in order to get deal flow, you have to have relationships with brokers. Again, real estate is a team sport. It comes back to relationships. So when you have a strong relationship with a top broker that trusts you as a buyer, he may bring you some opportunities. He may say like, hey, Key, I got the seller that has 50 units that wants to sell. It's a great deal. Take a look. And I'm the only one that's looking at that deal rather than being on market where thousands of other investors are looking at it. So this is why I fly thousands of miles, go to places like Columbus and Charlotte and meet the brokers. And, we want to tell them, who we are, how we operate, that we're serious about investing in this market, and, meet with the broker for dinner or some drinks. And that's really, I found, the best way to find the best deals.
That makes sense. Thank you. And I have a little second short question. Mm-hmm. When will you be on Bigger Pockets podcast?
Remy, the goal is not to get on, bigger stages. The goal is to just share what I know and my journey, and hopefully it helps somebody else. If it's helpful to someone in this meetup, great. And I think that's my way of giving back. So the goal is not to be a star or anything like that, but just simply sharing what I know if it can be a help to somebody else.
Thank you, Key. Captain, I don't have any more questions.
I mean, I was wondering that same thing. When is David Green when is David going to call him? Get you on there. That's awesome, man. Really, really good questions. Anybody else have anything for Key?
I'll just volunteer something, just a little bit about my background as poker, because as a poker player, because that's not something that's very common. And I met Jennifer and Remy through poker. And I realized that poker has actually been a sort of an MBA. It's taught me more about business than anything else. I think big part about poker is being able to make big decisions with limited information, and that's how life is, and that's how business is. And as I said earlier, it's very easy to be just bogged down by analysis paralysis, where you want answers to everything. But in life and in business, oftentimes we have to make big decisions with limited information. And I think that really helped me in the real estate business.
I have a question, T.
Yeah.
So, so since you have connection with brokers and in different states, so you might be buying up all these deals because you have a lot of connection. But let's say some of the deals, would you be open to maybe bringing deals to the table, maybe wholesaling some of the deals to people that like with less connection to the brokers?
That's a good question, Johnny. Like in the single family world, wholesaling is pretty common, where let's say I pass on a deal, but Johnny might want one. So I say, hey, Johnny, I don't want this, but do you want to buy it? And then I take like a little bit of commission. In commercial world with apartments, it works a little bit differently. The transaction is a lot more complex and involved. So the broker has to know the buyer. And the broker has to know, what he wants to know is, does the buyer have enough money? Does he know what he's doing? And is he serious about buying? Because the last thing anybody wants is for a deal to fall out of escrow. So let's say, I bring this deal to, somebody that I don't know very well. And let's say that buyer becomes very indecisive, even though he has enough information. Let's say on a walkthrough, he has never seen a Class C, product before. And then there's just a lot of maintenance. He gets scared off. He's like, oh, I can't buy. Now the broker looks really bad to the seller. The seller is going to be like, hey, what kind of buyer did you bring? Now, this guy's a rookie. So the broker wants to have confidence that the buyer is experienced, that they're serious, they have the money, and they know what they're doing. So it's not as easy for me to just bring a deal to somebody and say like, hey, do you want to buy?
Yeah, that makes sense.
Yeah, so I'll have to know the buyer. The broker will have to feel comfortable with the buyer, before we even think about something like that. Because in the single family world, you're hiring the broker, right? The broker works for you, or the agent works for you. In the commercial world, it's more of a partnership. The broker is checking you out as much as you're checking him out. The broker wants to know, hey, does this buyer have money? Does he know what he's doing? Is he a serious buyer? And is he not going to back out? So,
thank you.
Yeah, just to give you an example, like even for loans, right? A buyer needs to know, how to schedule all the inspections, how to qualify for the loan. Because if he can't get the loan, the deal falls out. So, these are all the things that the broker will look at when they meet a new potential buyer.
That's good. Thank you.
Any other questions?
I have one.
Yeah, Bob.
Mentioned Class C property. Can you explain what that means?
Well, Class A is like, in the best part of town where everybody wants to live, right? New product, something that was built maybe within the last 10 years. Class B properties, it's still a good area, maybe nice suburbs with good school districts, buildings that are maybe 20 to 30 years old. And Class C is more workforce housing, where more blue collar workers, lower rents, maybe worse school districts, but the rents are cheaper. And these buildings are going to be 30, 40, 50 years old. And most of our investments have been Class C, with the exception of 2 properties we have under contract in Columbus right now. One is Class A, the other one is Class B. But mostly we've been doing Class C value add projects.
Thank you.
Mm-hmm.
Key, we have about 10 or 11 minutes here before people are going to start dropping off.
I actually have a question.
Sure.
Doug, I couldn't help but to notice the periodic chart in the background. So are you a chemist or like what's going on back there?
Yeah, I am currently enrolled in Temple in my 3rd year of undergrad. I'm 21.
Mm-hmm.
So I'm a health professions major. I'm on the pre-med track. So I did all of my chemistry and sciences at community college, and I just kind of, when I came down here, I couldn't leave it back home, so I had to bring it with me.
Yeah, I was thinking that's a unique wallpaper.
I like it. Adds a little flair to the background for the Zoom meetings.
Sure.
Also, I do have a question for you.
Okay.
So, first off, thank you for coming and sharing all your experiences. What pieces of advice would you have for somebody like me trying to kind of rummage up start capital for an initial investment?
That's a great question, Doug. And first is to be an educator, right? Where you gather information, you learn about the business, but the knowledge is actually a small piece of the pie. The biggest piece is, I'll say, the mindset. For me, before I met the guy on Bigger Pockets, my reality was that I could only buy a 4-plex. But after I talked to him, my reality changed. And the only thing that changed was my mindset. And, I know I said this before, but, it's so easy to just be bogged down with analysis paralysis. There's so many different ways you can succeed in real estate. There is no one right way. If you just picked one that made sense to you and that you liked, and you just went all in on it, I'm sure you'll be very successful. So do some research, but take action. Take the leap of faith. And the best way to learn is to dive in head first.
Awesome. Thank you.
Mm-hmm.
I have another question, Key.
Yeah.
So you earlier mentioned the 506B fund. So can you explain that a little more?
So 506B fund is a syndication where I cannot advertise to the general public. I cannot raise funds from general public. I can only raise funds from people that's within my network already. I can also get money from people who are non-accredited. Accredited investor is somebody who has more than $1 million worth of net worth or makes more than $200,000 a year for the past 2 years. So for 506B fund, I can raise funds from people who are not necessarily accredited, but they have to be within my network. Whereas 506C, I can only accept money from accredited investors, but I can advertise to the public for raising funds. So you can think of 506B as a family and friends fund.
Is that something you have to register with the
SEC? Yeah.
SEC. Okay.
Yeah. So you have to have a syndication lawyer, a PPM lawyer, and they will make sure you're compliant with all the SEC regulations.
Okay. Thank you.
Mm-hmm.
George, I saw you pop your hand up. Do you have a question?
I did. I was going to ask if you did accredited investors with that, but that question was then answered. So thanks, Keith.
Anybody else have any questions for Keith? This has been a ton of awesome information. I have one before we kind of start a wrap up here. Key, what's your end goal? I know you're really crushing it here. Things are looking really, really good from all of our seats. What's your future? What do you see?
You know, Matt, the thing I love about the business is that it's very profitable, but it's also a team sport. Whether you're working with a broker, lender, property manager, and even tenants, right? There's a way to impact people that you work with. And as you make more money, there's also ways to give back to the community where you might mentor somebody, you might teach somebody. And for me, I love the way the business enables me to impact others, including this meetup where, I can come up, share my journey, share my story, share some of the knowledge that I know. And if it helps somebody else, I love it. So the end goal is to grow as big as I can so that I can impact as many lives as possible through, mentorship, sharing knowledge, financially, and beyond.
You come from very humble beginnings, and for guys like us, it's a dynamic world. Everybody here has, I believe everybody here has jobs outside of real estate. That's a really awesome thing to hear you and your story and have you be so humble about it. A lot of guys get that head that can't really leave the room because they feel so inflated of what's happening, but you really break it down to the bare bones, and you're a wonderful presenter. And I know that everybody on this call is extremely thankful, and that there's a lot of people who are not able to be here today. But I personally want to thank you for, first off, responding to me a while back, the conversations that we've had, and then coming on here. And I hope that we can, have you guys, specifically you and the other members you brought in the call, on more frequently, because we have a variety of subjects, a lot of different things to discuss, and just the more input, the better. And I really, personally, I appreciate all the input you brought here today. So hopefully you can connect with some people and this can work. It's all about the networking you do here. This is great.
And Matt, right back at you. Thank you for having me and inviting me, and I'm just honored to be here. And I look forward to connecting with any and all of you to see, how we might be able to collaborate. Because in this business, you never know who's going to be your next buyer, seller, investor, or even partner. So I just love to meet people, hear their journey, and see how we can collaborate.
Thanks, Keith. Anybody else have any last minute questions? We might wrap it up a little bit early here. All right, we're going to send a proof out to this for you to kind of make sure you like what you see before we make the video public. But everybody, we have our, I'll just share this really quick. Give me 2 seconds. Well, first off, I'm going to share this. This must look familiar to someone on the screen. This is Key's website. It's pretty awesome. When you get some time, elevaterei.com. It has their whole deal here. Check it out. I'll put it in the notes and in the email we send out. It's a really stellar presentation. Has all their information, the stuff there. And then this is the REI Partners Meetup. We finally have a website. It's very basic at this point, but we're going to start putting all of our content here, meetup archives, analysis tools, ways to connect. We'll give everybody some login information so we can maybe keep some of the information off the public view, because there could be some private deals that we talk about in here. And then the other portion here, if we go to the YouTube channel, whoop. Here's all the videos we have from the past. Everybody see this here? this domain is fairly new, a few months old. We have all of our videos on my company page prior to December of last year. There's about 12 of them there, but now we have these, and it's turning into quite a formal thing so that we can provide more content for everybody. So check out the YouTube channel. There's a Facebook page, just the at REI Partners. It's a whole bunch of information. Again, it's all free. We're just trying to collaborate because we know that if at any point in the future we do business together, it's worth more than just this meetup. So Key, I really appreciate your time. We'll send an email out with everything that was discussed today, contact information. I know guys are sharing it in the chat. If you want to throw your stuff in there before we part ways, feel free so everybody has a copy of it. But I'll reach out. If you can have everyone that joined Key from your group, have them reach out to me with that email. I'll get them onto the list for the future ones. And if you guys have anyone else who'd like to participate, please let us know, because again, the more contributions, the better here. So
thanks, Matt.
All right, guys, have a great weekend. I hope not everyone is enjoying the snow like we have in Eastern Pennsylvania today. But again, thanks everybody for your time. I appreciate it all, and I'll be in touch.
All right, thank you.
Thanks.
Thanks, guys.
Thanks, Matt. Great meeting.
Thanks, Matt.
Thanks, Matt. Thank you.